This segment sponsored by Foster Financial. Welcome to Wealth Wednesday, where we provide you with holistic financial advice from Foster Financial. And joining me today is Caleb Doane, their vice president. Good morning.
Morning.
How's it going?
It's going pretty well. How are you doing?
Yeah, doing good. Okay, so we have been having this conversation about something that you may be a little scared about, the tax changes that are being proposed. And so we've been discussing it for the last couple of Wealth Wednesdays, but you have some more information to share with us today.
Yeah, definitely. Anytime they talk about tax changes, it gets a little scary, right? So we already know there's tax changes that are expected at the end of 2025, so basically taking place starting in 2026.
Okay.
And that's basically, tax brackets are snapping back up to what they were at prior to 2017. So if you're right now in the 12% tax bracket, you're going to move up to the 15. If you're in the 22, you're going up to the 25. So taxes are getting more expensive.
What? So wait, so this is something that will apply to everyone, not a certain income level. Everyone's taxes will be raised?
So if you're in the 10% tax bracket, which is like $0 to $23,000 or something like that, that's staying the same, but everything else is going up. So it's going to apply to, nearly everybody.
So it's like when these taxes go up in such a dramatic way, because you're saying like 3% and more perhaps, will we see the impact in a different way? Like, will we receive benefits from these taxes going up?
Oh gosh, yeah, we'll see. So the taxes going up, certainly don't really do much to cut into the actual government deficit. We're still going to be operating at a deficit, which is why some people think that, hey, this might not be the only tax increase in our lifetime, right? So it's very feasible to see that, in the future, the only way to reduce the deficit is either spend less money or bring in more money. And the government really likes spending. So in all likelihood, they're going to need to bring in more money, likely by raising taxes.
And I know before you had talked about the credit score and changing for the government.
Oh gosh, yeah, that's true.
So it's like, what is happening? And maybe that where's our money going is more of a question for a politician.
Right.
Where are you going to spend our money? So how does it affect us in investment and in our retirement, these changes?
Yeah. So the biggest thing we think about and what we call this is legislation risk, which is basically the risk that the government could change the rules and all of a sudden it impacts, your retirement funds. So one of the biggest accounts that's affected by this are people's 401ks, which they often roll into a traditional IRA when they retire. Because those accounts are what we call pre-tax, which means they've never been taxed before. So when you do pull money out, that money gets added to your taxable income and you pay taxes on it.
So that means that even if you put money in an IRA and you were in a smaller tax bracket, when you want to get that money out, you have to pay the higher percentage.
Yeah. It's in the year that you pull that money out. And so, you might be right now anticipating, hey, I'm going to be in the, 22% tax bracket when I eventually pull this money out. The government could change the rules by the time that you go to take money out. And so it's possible, they could say, hey, income tax rates are now higher, so you're going to have to pay that higher rate.
That's so fascinating because I know that this conversation, I feel like it's almost flipped. Because I remember a time when putting money in your IRA, it's like, okay, you pay higher taxes when you're younger, or if you have, if you're single and you don't own a home, but then when you get older and you have a family, you get more dependents, you have bigger assets that you can write off in a way, then your tax bracket decreases.
Right.
But now it's like, wait a minute, we may have to do something different.
Yeah, that's the thing. If you just think to yourself, hey, do I think taxes are going up generally or going down? Most people are telling you, I think they're going to go up over my lifetime. And there are a lot of people when they retire, their tax bracket drops. But as soon as required minimum distributions start, a lot of times people get kicked into a higher tax bracket. Or, heaven forbid, when a spouse passes away, you're now a single filer, you're typically kicked into a much higher tax bracket. So in the meantime, what we do is we're like, okay, how do we reduce our legislation risk in our portfolios? And one of the biggest ways that we do that is through Roth conversions. Because Roth conversions basically move money from that pre-tax bucket, the IRA, the 401k, into the Roth bucket. When the money's in the Roth bucket, you've already paid taxes on it. and the government has their hands off it. So if you take withdrawals, regardless of what the tax bracket is, you pay no taxes on it.
Yeah. Okay. So let's break that down for a minute. So you have a traditional IRA and you have a Roth IRA. And so can you break down the difference to our viewers?
Yeah, when you contribute to a traditional IRA, you get to write it off on your taxes. So you get a nice little tax break when you contribute, but the deal you make is that whatever you contribute grows in the market, and then when you pull it out, you pay taxes on whatever you pull out. With a Roth, when you put money in, you don't get the tax break initially, but it grows completely tax-free, and when you pull it out, you don't pay a dime in taxes.
Okay, so a little example, let's say that someone has $1,000 and they put $1,000 in their traditional IRA. They do not pay any taxes on it. And then as it grows, let's say it gets to $5,000, they're now having to pay 20% interest on $5,000 as opposed to the $1,000 that they put in.
Right. Yeah. If they're in the 20% tax bracket and they pull that out,
they're having to pay that. But if it's Roth, you're saying they can pay taxes in advance on that money. So if it's $1,000, they have to pay 20%. Was that $200 that they have to pay on that? And then if it grows to $5,000, they keep all of that.
Right.
And they don't have to be taxed. You see? So that's kind of cool to first off know the difference, that you have options, but then kind of weigh out which one is the best one and when's the right time to do it, especially with these changes happening.
Oh yeah. Like 2024 and 2025 are likely going to be some of the biggest years for Roth conversions because we know the taxes that are coming. We know that it's going to increase. So the people that benefit the most from this are people who are probably in their 60s to early 70s, they're retired, and they're in a relatively low tax bracket right now, and they have a lot of pre-tax money, like IRA money. We can look at that and we say, hey, you're in the 12% tax bracket right now. You're never going to be in that again for the rest of your retirement. Let's take advantage of that 12% and convert a lot of money over to Roth at this really discounted rate. And then in the future, we can avoid getting kicked into a higher tax bracket. So there's just a lot of tax benefits, especially for people in that category, but we like to reduce legislation risk regardless of how old you are.
Yes, that is true. And so you foresee seeing a lot of Roth conversions happening. And so correct me if I'm wrong, but you can convert from traditional to Roth, but you cannot convert from Roth to traditional.
So basically you would never want to, right? Because I mean, the money, once it's in that Roth account, it's tax-free. That's kind of the best place for it to be at. So I'm letting it stay in there and grow tax-free and come out completely tax-free.
Okay. The IRAs is bringing back my bank days, my financial days back in the day. So this is all good stuff, good information. So, but people can have a customized strategy. They just need to come in and kind of show you all what they're working with, and then you can guide them.
Yeah, that's exactly
down the right path. Okay. Well, thank you so much, Caleb.
Yeah, thank you.
See you next time.
Yeah.
And if you would like more information about Foster Financial, you can actually have a complimentary consultation. We'll have their phone number listed below, and I'll see you after the break. This segment sponsored by Foster Financial.